Last week, the Italian government surprised pretty much everyone, announcing a windfall tax on banks' extra profits. Market responded very quickly, sending the Italian bank stock plummeting on the Milan Stock Exchange. Meloni government said that the recent rise in the cost of borrowing for household and enterprises has not been reflected in a fair increase in the return for their deposits. Therefore, the new tax will be used to cut taxes and offer financial support to mortgage holders. Today, I'm joined by Johann Scholtz, European bank equity analyst at Morningstar, so that we can understand the risks for investors and customers. Johann, in a recent note, you said that the hit earnings took from Italian windfall tax on banks is manageable, but the negative impact on sentiment is far greater. What are the main risks for investors?
Thanks, Sara. Yes, we estimate that the proposed windfall tax will shave off around 10% of Intesa's 2023 consensus estimate earnings and about 6% for UniCredit. Now, it's limited to the bank's respective Italian operations, and because Intesa has got a greater portion of its revenue coming from Italy compared to UniCredit, the impact is slightly greater on them from an earnings perspective. But like I said, the bigger impact, I believe, is on the risk premium, if you like, what investors will demand from banks going forward to compensate them for the risk of government intervention. And, this is not the first time we've seen this in Europe. Spain has also implemented a windfall tax. And then we've, of course, had the ban on dividend distributions during the pandemic. And, I think investors also don't like uncertainty. And the fact that this announcement came completely out of the blue, I think spooked investors and introduced volatility into the share prices.
In the transition to a higher interest rate environment, most banks have seen their loan books repriced to higher yields. This has not been coupled with a small increase in current accounts rates. Do you think that in the future banks will be forced to increase the passive interest rates they pay? If yes, what will be the impact on account holders?
Yes, Sara, I think it's important to distinguish between a current account and a savings account. In many jurisdictions across the world, current accounts pay little or no interest. It's not meant to be a savings product. It's largely a transactional product. Now, I know the situation in Italy is slightly different, where the large banks are not necessarily aggressively marketing savings accounts as a product to clients. And I think, that is really what the Italian banks should start doing, is to illustrate to clients that there are alternatives to keeping your money in a current account. I know some of the smaller Italian banks are offering savings products paying up to 3% interest. So, I think what we'll probably see over time is that interest rates, like anything else, is a question of supply and demand and competition. And as competition increases in the market, one should actually see higher interest rates filter through. But yes, I think there is a potential risk for banks that there might be further regulatory intervention to force them to pass on a greater portion of the higher interest rates to savers.
In time of high inflation, cash is a poor asset allocation decision. Should investors look for alternatives?
Yes, I should maybe start off by saying that each individual's personal circumstances, of course, are different. So speak to your financial advisor first before making any changes to your asset allocation. But yes, generally in an environment of high inflation, cash is a poor investment. You know, if you look, even if you do manage to get that 3% interest that we were talking about earlier, in an environment where inflation is running at 6%, it was at the beginning of the year, it was touching 10, 11%. In that kind of environment, in real terms, you're losing money. Traditionally, equities has been viewed as the best hedge against inflation. And yeah, if you look at our Morningstar developed markets wide moat focused index, that's up by 12% year to date. And over the past decade, it's delivered an annualized growth rate of 11% per year. And that's materially ahead of inflation over the same time frame. For more risk-averse investors, there's other products available, but once again, best to talk to your financial advisor about that.
Well, Johann, thank you very much for coming here today for Morningstar. I'm Sara Silano.